Over the past couple of years, we've seen that Air Canada shareholders have been going into a real roller coaster valuation-wise, while more recently, the company was talked a lot about in the medias because of a big strike that was made by their flight attendants. But is this airline company still a good investment from an investor point of view? This is what you'll be discovering in this video, where I'll make a full stock analysis on the company Air Canada with the ticker AC. As always, I'll first start by taking a peek at what is their business model, so how are they able to generate their income, and what have been their more recent news that have impacted their financial results. And then we'll make a quick fundamental analysis followed by a price prediction with different valuation models to see what is the true intrinsic value of this company. Air Canada was initially founded in 1937 by the federal Canadian government and was held as a subsidiary of the Canadian National Railway. The objective behind it was to have our own air public transportation services in Canada. Throughout the following decades, we've seen that Air Canada has become quite important to our economy and has become a private company in 1989. And since then, it has become the largest airliner in the whole country by delivering passengers and cargo to over 200 destinations. With no surprise, when we look at their latest earnings report, we see that the largest chunk of their total earnings in the past quarter came from the transportation of their passengers, which were of $5 billion, or about 90% of their total operating revenues that were estimated at about $5.6 billion. However, we can see that this $5.6 billion only represents a 2% increase compared to the number that it was 1 year prior. Some of the other important components that you need to watch for when you analyze different airliner companies are notably first the revenue passenger mile, so the number of miles traveled by paying passengers, and you also have the available seat miles, so the airplane's carrying capacity to generate some revenues. This second one is pretty interesting because when we think about the available seats, usually we could think that the higher this number is, the worse the situation is for the company. But this could actually be a good thing in only one scenario. In fact, an increase in the available set miles could be interesting when you have a bigger increase in the total demand of passengers. So in the case that the revenue passenger per miles will increase as well. And fortunately for Air Canada, we've seen that it has been the case for both criteria, where we've seen an increase in the demand of passengers as well as in the availability of their seats. Unfortunately, however, we can see that year over year, we've seen a certain decrease in their adjusted EBITDA as well as a massive decrease in their total free cash flow. And unfortunately, we've also seen that their total net debt has been surging, which is not a good thing for a company like Air Canada that is not able to consistently grow massively their total revenue and their total adjusted EBITDA. But now let's see what the more recent Air Canada strikes mean for the total expenses and for the future earnings reports of this company. First, just to put a little bit of context, what is the origin of these strikes is the fact that the flight attendants were not paid until the doors were closed and that the planes were moving. So in my opinion, the flight attendants were rightfully protesting because they are the ones that will have a lot of work to do before the planes goes out, notably to welcome all the passengers and to prepare the planes. The only problem with that for the company is that this will make their total expenses surge over the next couple of years. With the recent agreement that they've successfully completed with the flight attendants of an increase of about 40% over the next 5 years of their total compensation package. Plus, it is estimated that the company has lost close to $60 million only for the 1 day of strike because of notably all the fees that they need to refund to their travelers. And at the moment, the company doesn't have a lot of cash on hand compared to their total debt, which might represent a certain problem. So as good as this news is for the flight attendants, this isn't necessarily the case for the investors and even for the travelers using Air Canada, because eventually to keep the same profit margins, they might be forced to increase their total price. Add to this, another problem that I've spotted in their latest earnings report is their target that are set in terms of their outlook for 2028, where they forecast some slow growth of about only 8% per year to reach about $30 billion of total revenue in 2028. So this would mean that regarding that aspect of the company, there would be way better options on the market right now in terms of growth, notably the big tech companies in the US. But before to take any conclusion, let's take a look at the different fundamental metrics of this company to see what is the true intrinsic value of AC stock at the moment. In terms of the valuation of this company, we can see that over the past year and a half, it has been fluctuating quite a lot between 4 to about $7 billion, while it is currently sitting at about $5.55 billion. And we can see that in terms of its price to earnings ratio, only regarding this aspect, it would be massively undervalued with a P ratio of only about 5 right now. Now, in terms of their profitability, we can see that they have some pretty low profit and operating margin of about 6 and 7%. But over the past 12 months, they've had some incredible return on equity of close to 100%. Over the past 12 months, we can see that they've been able to generate some revenue of about $22 billion with some slight increase in their latest quarterly revenue growth, as I mentioned, of about 2%. But unfortunately, we can see that on their part, their earnings growth have been massively diminishing of about 44% year over year. As I also mentioned earlier, this company doesn't currently sit on a lot of cash, only about $6 billion compared to a massive debt of close to $12 billion, where its total debt represents over 659% more than their current equity. In terms of the volatility of the company, that is represented by the beta on a 5 years period, we can see that this company will tend to be about 2 times more volatile compared to the overall market. And surprisingly, even if it hasn't been able to beat the stock market performance over the past 5 years, we can see that over the past year, it has been able to outperform it with some return of about 18% compared to about 17% for the S&P 500. In terms of the total revenue progression over the past 4 years, we can see that compared to 2021, they've been able to massively increase their total revenue, but it might not be the best comparison since in 2020 and in 2021, we were during a massive COVID lockdown where pretty much no one was allowed to go outside of the country. Nevertheless, we can still see that over these past 3 years, they've been able to consistently increase their total revenue, even if it hasn't been some big growth. However, we can also notice that their total expenses have also been surging for this period, which has made that their total earnings before interest and taxes have been on the diminution since the past 2 years. In terms of the operating cash flow, we can see that they were negative in 2021 because of the COVID lockdown, but since the past 2 years, unfortunately, we can see that they've also been quite importantly decreasing. And when you combine that with more capital expenditures fees, it has made that our free cash flow have also been shrinking quite importantly over these past 2 years. But now, to determine what is the true intrinsic value of this company, we'll be using many different valuation models to help us with this task. Starting out with the Peter Lynch valuation model, which is a simple formula where you add the future growth of the earnings per share with the dividend yield and that you divide it with the price to earnings ratio. And even if the company isn't distributing any dividend at the moment, since it currently has a pretty low price to earnings ratio, we could find that this company would currently be quite fairly valued. Unfortunately, as I just mentioned, since it isn't giving any dividends to their shareholders, we can't use the dividend discount model to help us find what is the true value of Air Canada stock. But for the third model, which is the discounted cash flow model, we will simply discount all the future free cash flow of this company to find the enterprise value of it. And the first thing that we need to find is our discount rate, so the WACC, where we will simply find the cost of debt, the cost of equity, and the cost of debt and equity to find our WACC. And with this measure, we can find that at the moment, the company would currently be quite undervalued with some upside of less 22% compared to its current price. Finally, for the last models that I'll be using both the Graham's original value formula and the Graham's revised value formula. And in both cases, we can see that they would be showing that this company on their side would be undervalued right now. So as you can see, the valuation model's results are pretty mitigate about the true intrinsic value of this company, where some are telling us that this company would be undervalued and where some others will tell us that this would be overvalued. However, knowing the slow growth that is forecast concerning this company over the next couple of years, I would personally stay away from this business at the moment, because it is also important to note that this isn't a company that is giving any dividends to their shareholders at the moment, and at the same time, it hasn't been giving any type of growth over the past 5 years. So from my own investor point of view, I believe that there are still way better options than this on the market right now. Talking about these options, if you are looking to find some of the absolute best stocks to invest in right now, make sure to check out the video that's gonna be right over here, and I will see you soon. Peace.